Okay students, this is the second half of the paper. So you would be an hour into the exam at this point, or halfway through the exam depending on your time. Another case study to read, so look at the questions first, then again 2 questions to choose from, which will be your essay questions. So half an hour for the first 3 questions, half an hour for the second question. So the first question is an explain question. Reference to figure 5, so we know there's some data that will be the key application for that question. One likely reason, so only one reason needed for this question, and when it says one, you don't need to define in this question. You're just going to state that reason, that will get you your K mark. Fall or weakening, so again you can annotate the question of the exchange rate of the Turkish lira. So there's potentially more than one currency, but we're referring to the Turkish lira, and if we want a figure 5 data analysis mark, we're looking just for the Turkish lira in that. The second question is the discuss question here. So this is our 2 sides and a judgment part of it. The next question says examine, which is just the same as assess, so that's just the 2-sided question there. So the previous question discussed the costs, but really costs and benefits, because it's a discuss question, to the Argentine economy. So that's the focus of the question, of an inflation rate estimated by some economists to be over 25%. Now the fact that it says estimated there, that gives us a nice potential judgment around the accuracy of the estimate. So one way that we can get that level 3 evaluation is to be critical of the information we're given. The last question here in the case study section, with reference to extract E, so we're looking for some application from extract E, assess or examine 2 sides, the impact, so positive and negative impacts of restrictions, so they are restricting. Another way of saying that would be protectionism. So again, we could annotate this just to remind us of the topic on beef exports, and the key part here is the word exports, as most of the protectionism we've looked at has been on imports. This is going to be a little bit different. So there's restrictions on beef exports, on how Argentine farmers decide to use their land. Okay, now the first 2 questions, so we've got exchange rates and inflation rates, these are macro questions. So if we spot the correct topic, the first one is our macro, or one of the macro questions, and the second one is a macro question as well. The third one, when it's saying impact of restrictions on how Argentinian farmers decide to use their land, is a little bit of macro and micro. So this is kind of a synoptic question, because the protectionist measure is a macro thing, but the micro is the allocation of resources, or the basic economic problem there. Okay, then at the last part, you'd have your choice between the 2 essay questions with reference to the information provided. So this is saying there's potentially some information in the case study that you want to use, but you could also use case studies that we've looked at over the year. Evaluate, so 2-sided and a judgment. The likely micro and macroeconomic, so synoptic, effects, positive and negative, of the imposition of price controls in Argentina. So price controls are another way of saying max or minimum price. And as it's macro and micro, you'd be looking at specific markets, but also at the wider Argentinian economy. Or you could choose the next one, same structure, but this one is the effects of the 23% devaluation of the peso. So be careful, because the very first question is looking for the reason for it. You don't want to be repeating your analysis of why the currency or a currency devalued in the first place. It's the effects of it. So just be careful that you're not repeating the analysis of why the Turkey currency weakened. You're just looking at the effects of that on the economy, positive and negative. Okay, so this was figure 5 that they were referring to. what you've got is emerging economies exchange rates against the US dollar. So it's the value of the lira in terms of the dollar. There is an index year, which is 2013, and what you can see is that there is a devaluing of all the currencies up until January 2004. We're just looking though for the Turkish lira, and the Turkish lira is this currency here, and it's saying at the end of that period it's at 86. So we have a fall of 14%, which is the key application that we can get from that. If you want it to be a little bit more specific, there is it ends up a little bit higher than its lowest point, but that's the main bit of application for that figure. You also have potentially the Argentine peso for later in the extract, and it talks about a 25% devaluing, but you also have a significant change here in terms of how volatile that change is. So within 1 year it reduces approximately, or even just within 1 month it reduces approximately 20%. Now that will be useful in terms of the significance of that 25% or 24% devaluing. If it happens slowly over a period of time, it's less significant than if it happens rapidly in a volatile fashion like it has there. Okay, figure 6 is showing Argentina's annual growth rate, so the percentage change year on year in the real GDP. If you think, or if you look across, you just want to draw a line yourselves in the exam, that would be 0, just so it's very clear. Apart from, and remember, between this period and this period is the kind of global or the Great Recession. However, you do have another period here and here where again the economy seems to have a significant slowdown, possibly not quite a recession, although that potentially is 2 consecutive periods of negative economic growth. What you do have is an average for most of the period outside of those two of between 8 to 10%. So if you're taking, and real GDP is taking inflation into account, so the economy within those periods is increasing standards of living at a significant amount for a less economically developed country. This chart is showing Argentina's balance of payments on the current account. The scale it's using is millions of US dollars. However, if you wanted to be critical of that, it doesn't necessarily show it as a percentage of GDP, which can be more relevant because that takes into account the size of the economy. But what you again should do is just take a line across the chart to show you where surpluses and deficits would be. So for the vast majority, up until about 2009, Argentina was running a trade surplus and an increasing trade surplus over time. Since then, since the Great Recession, it's steadily moving towards a persistent deficit. So it does have periods of surplus, but it also has periods of a worsening trade balance. And over the recent years, it seems to be that most of its time is spent as a trade deficit. Okay, so extract C, fall in the exchange rates of emerging economies. In 2009, GDP in emerging economies grew by 3.1% on average. So it's talking about growth rates there, whereas it fell by 3.4% average in advanced countries. So in terms of differences between developing and developed world, it's saying that there was growth in the developing countries, but economic recessions in developed countries. Capital poured into emerging economies from investors looking to earn reasonable rate of interest, to transnational corporations undertaking foreign direct investment. So we do have 2 reasons there why initially their currencies, or the balance of payments on the capital account side, has improved. However, a slowdown in economic growth caused by concerns, which in turn led to panic, has resulted in the single biggest sell-off of emerging market currencies since 2009. So it's saying there is a significant sell-off, partly caused by investor expectations. In January 2014, the Argentinian peso fell by 23%. So we have a specific amount there, which is given in the question, after its central bank stopped intervening to maintain its value. The Turkish lira fell 6%, but that is just in that period that it's talking about, and only recovered slightly despite the rise in the central bank interest rate from 4.5% to 10%. So there's an example of a monetary policy intervention, which again could be used to evaluate a question around exchange rates. There are two main causes of these currency depreciations: an announcement by the US Federal Reserve that it would start reducing the amount of quantitative easing, and the slowdown in the economies of emerging markets. So here you've got two reasons for the weakening currencies. One is their growth rates slowing. The other one is if the US Federal Reserve reduces quantitative easing, this will have the effect of strengthening the American exchange rate as the value of the dollar will go up. So it will increase relatively the return people will get from the American currency. So demand will flow back to America. In particular, the report of a fall in China's rate of economic growth. China is not only the world's largest emerging market, but it's also the chief buyer of exports from other markets. So the lack of demand from China from exports of other developing countries would also reduce the demand for their currencies. Extract D, Argentinian government intervenes to prevent a further fall in the peso. The Argentinian government said in January 2014 that it would not let the peso fall any further after the authorities devalued the currency by 23%. So you've got some information here, and again this is useful for a judgment of what might happen in the longer term. So the devaluation is the latest attempt to stop capital flight, to prevent a rapid decline in foreign reserves and avoid a balance of payments crisis. So there are two negatives mentioned there around the devaluation. The exchange rate was just over 8 pesos to the dollar on the 23rd of January 2014. Foreign reserves have fallen significantly over the past year. Economists have welcomed, and a lack of foreign reserves is also a negative in terms of a developing economy. Economists have welcomed the government's desire to remove the currency controls aimed at managing the exchange rate. So they used to have a managed exchange rate as one of their solutions to the developing problems. They also said did not get to the heart of the problem, the need to tighten monetary policy to slow soaring inflation. So reference to the link between inflation and monetary policy, estimated by some economists to be over 25%. The government has recently sought to reduce the rate of inflation through price controls. So they aren't trying to reduce inflation by having higher interest rates. What they're actually doing is intervening through regulation. Argentina has a history of sudden devaluations. Many economists fear that the recent devaluation could further fuel inflation as a fresh round of wage bargaining. So that wage price spiral may occur. 2013, police strikes over low wages that had not kept up with inflation led to widespread looting and social unrest. So there's a negative of inflation linked to that price wage spiral. Further problems include relatively low commodity prices, which are reducing the balance of trade surplus. So we've got a primary dependency argument there linked into the Preibisch-Singer hypothesis. Further, the government's policy of printing money to fund social spending is increasingly unsustainable at a time when the fiscal deficit is growing. So we actually have examples of printing money or quantitative easing increasing the supply of money, and that potentially being one of the causes of inflation. So when judging again how significant inflation is, the cause of inflation is one key way to do that. Final extract, Argentinian beef. 100 years ago, beef made Argentina rich. Today it is making Argentina poor. So beef is a primary commodity, it's a food crop. On average, Argentines eat 64 kilos of beef a year, more than twice the amount eaten by consumers in the US or Australia. Argentine beef industry is suffering from the effects of government intervention in an unfavourable macroeconomic environment. A 30% jump in beef prices between November 2013 and March 2014. So we have the benefits of primary dependency there, that if the price is rising, potentially you can make more money from it. But this led to a drop in consumption domestically. We're going to have to approve measures that once and for all defend consumers from the abuse by powerful sectors, oligopolies and monopolies. So there's a mention there of market structures, specifically uncompetitive market structures. So in a question, that might be a micro topic to balance with the majority of the macro topics which I mentioned here. She's attempting to impose price controls on almost 200 supermarket items with threats of fines or closures for offending. So now we can see what type of price control it is. If it's to try and tackle inflation and it's trying to bring prices down for consumers, it's going to be a maximum price. We also have a little bit of information about the effectiveness of that, because it's threatening fines or closures for stores who do that. So this might be a relevant one to use for a diagram as well. A cabinet minister threatened last month to step up intervention in the beef sector. The sector has already suffered almost a decade of export restrictions. So what I was saying earlier about being careful, that this is about protectionism, but export protectionism. So the export restrictions could be export tariffs, or they could be export quotas. So there is if you increase the price of exports, it will keep more of those exports in the domestic market because you can't sell them abroad. And also if you put export quotas on, again, it increases the supply of beef domestically rather than it going abroad. But it's also mentioning some of the negatives of maximum prices, and it's forcing cattle farmers out of business. The restrictions introduced on beef exports since the devaluation have caused beef exports to drop by 50%, a key figure for application there, despite the fact that rising global beef prices could have been advantageous for Argentinian farmers. So it's saying that primary dependence, if they had high beef prices, could have been good for the farmers. Over the past decade, the government intervention has caused Argentina's stock of cattle to shrink to 48 million, a drop of 10 million. Again, some key data there that we could use for application. And it's now not the third biggest beef producer, it's the 12th biggest beef producer. Beef tends to be an income elastic product with a high YED, so in terms of demand for it, it's likely to go up in the future as well. And it's now saying that the exports of it have fallen to 7%. So again, something that may be affecting the trade balance of Argentina. Under such conditions, many farmers have switched from raising cattle to growing soya. So now we have a potential of a PPF, an opportunity cost there, benefiting particularly from rising demand in China that has caused prices to soar. So naturally there's an incentive through the price mechanism for farmers to reallocate that. Again, another economic topic that you might want to include. Soya exports have become fundamental to the Argentine economy as a major source of foreign exchange. Total agricultural production, including beef and soya, accounted for half of Argentina's exports. So again, we know that those are two very important crops. Probably depends upon which one potentially could gain the greatest value. So was beef a better crop to be exporting rather than soya?